Hi, it's July 2014, and I hope you're having a good summer so far. For the second quarter, I just wanted to provide a couple of updates. First, there is a 2-minute video from Rick Valero, the Chief Investment Strategist of the investment team. I'll also provide a second quarter summary to give some perspective to the markets while we prepare your performance reports.
Since our last video in April, the investment team has spent some time reviewing the evidence. That means we looked at the US and global business cycle, technical conditions, valuations, quantitative analysis, and the independent reads that we look at every day. In the final analysis, and after a lot of work, our decision was that the evidence was neutral, and that meant that our portfolio volatility should fall in line with that neutral assessment. Given that we were looking to move our portfolios back to a state of neutral volatility, we decided to draw a line in the sand on the S&P 500. For us, it was okay if the market decided to move laterally or down, but if the market moved up, we decided we were not going to fight the tape. In late May, the market did move up, and we brought our portfolios to a neutral position. Our current theme is to fade the interest rate trade. That means that we believe that the US economy is reaccelerating right now, and that the greater probability over the next 3 to 6 months is that interest rates will go up. Therefore, we want to align our portfolio with holdings that do well in an environment where the US economy is reaccelerating, and also begin to pare back holdings that don't typically fare well when interest rates rise. Recent trades into technologies and industrials, as well as selling government bonds, as well as utilities and telecom services, are examples of trades that align with our new view. In conclusion, the bull market is maturing, and we don't think it's the time to overweight risk. Right now, the weight of the evidence says that we should be neutral in our portfolios, and that we should align our positions to benefit from an improving US economy.
This is a global markets summary for the period ending June 30th, 2014. And it gives some key indices to give us some idea of how various parts of the investment markets have performed. We start out by looking at US stocks. US large cap stocks did particularly well during the second quarter and year to date, while US small cap stocks lagged a little bit. In foreign stocks, foreign developed also did well, not quite as good as the US large cap, and we saw a rebound in emerging market stocks, which have lagged quite a bit over the last 3 years. In fixed income, we also see nice returns for the quarter and the year to date. Investment grade bonds performed in line with municipal bonds when you consider the tax-free nature of municipal bonds, and high yield bonds had a little bit higher returns as well. In commodities, which is a little bit harder part of the market to truly benchmark, we see that commodities were pretty much flat during the second quarter, but year to date, the returns have been pretty much in line with large cap US stocks. So this gives some perspective on how the markets have done. Benchmarking and indexes are not perfect, but it does give us some sense of how portfolios should be behaving. So if you are have a higher allocation to stocks versus bonds, your returns will be a little higher. If your allocations are higher to bonds, then your returns for the quarter and year to date would be a little bit lower. And I hope that perspective helps a little bit. So I hope this summary has been helpful, and I hope you continue to have a good summer, and I look forward to talking with you soon.